Hey everyone, and welcome. Today, we're going to dive into one of the most powerful and, surprisingly simple tools for building long-term wealth. We're talking about the index fund. Let's find out why it's become such a game changer for so many investors. Okay, let's be real for a second. Investing can feel like this super complex, high-stakes game, right? Like it's reserved for Wall Street geniuses. We always hear about people trying to beat the market. And for most of us, that just sounds, well, complicated, risky, and frankly, pretty intimidating. But what if that's the wrong way to even think about it? Well, here's the good news. There's an incredibly elegant answer to all that complexity, a way to flip the script and turn that complicated game into a simple and really effective strategy. And that answer is the index fund. So, what on earth is an index fund? Think of it like this. It's an investment fund with one very simple job: to mirror or track the performance of a market index, like the famous S&P 500. The goal here isn't to be clever and outsmart the market. The goal is to be the market. And this really gets to the heart of two totally different ways of thinking about investing. On one side, you've got active investing. This is where fund managers are constantly buying and selling stocks, trying to pick the next big winner. All that activity, well, it comes with higher fees. But on the other side, you have passive investing, which is the whole idea behind index funds. It's automated, it just tracks the market, and because of that, it has much, much lower fees. So why are these things so popular? What's the big deal? Well, it really boils down to three huge advantages. First, the costs are super low. Since there's no big team of analysts to pay, more of your money stays in your pocket, working for you. Second, you get instant diversification. With one purchase, you're spreading your risk across hundreds of different companies. And third, it's just simple. It's easy to understand and its performance is totally transparent. All right, so theory is great and all, but let's make this real. Let's look at the most famous market index on the planet, the S&P 500. This number, 500. This is what it's all about. An S&P 500 index fund is designed to track the performance of the 500 largest, most influential public companies in the United States. And just look at the scale we're talking about here. When you invest in a single S&P 500 index fund, you're capturing about 80% of the entire US stock market's value. Think about that for a second. One investment gives you a huge piece of the American economy. And we are not talking about some obscure companies you've never heard of. You know these names. In fact, you probably use their products and services every single day. We're talking about giants like Apple, Microsoft, Amazon, and Google's parent company, Alphabet. They're all in there. So how does this actually work? It's as simple as 1, 2, 3. Step 1, you put your money into an S&P 500 index fund. Step 2, that fund automatically uses your money to buy a tiny little slice of all 500 of those companies. And step 3, as the overall market grows, so does the value of your fund. You get all that growth without ever having to buy 500 different stocks yourself. But here's the really cool part. This whole index fund idea is way bigger than just the S&P 500. It's actually a super versatile toolkit that you can use for all sorts of different markets. You can go even broader. For example, you can buy a total stock market index fund, which includes pretty much every US stock, small, medium, and large companies. Or you can go global and buy an international stock index to invest in markets in Europe and Asia. Or maybe you want to add some stability to your portfolio. You can do that with a bond index. The same simple, low-cost principle applies to all of them. Okay, let's tie all of this together. We've looked at the what, the why, and the how. So what's the one big thing you should walk away with? And hey, you don't just have to take my word for it. Warren Buffett, one of the most successful investors in history, has been saying this for decades. His advice is crystal clear. For most people, a low-cost index fund is the most sensible way to invest in equities, in stocks. So let's just recap the strategy. With an index fund, you get to tap into the broad returns of the market, you keep your costs incredibly low, you're instantly diversified, which lowers your risk, and maybe best of all, you just simplify your financial life. And that really brings us to our final thought. It's a question worth asking yourself. When it comes to building your financial future, is it possible that the simplest path is actually the wisest one? Something to think about. Thanks so much for tuning in.